This is not real money, but the math is very real. I ran a hypothetical all-in scenario on CHPY, CHPY, and tested multiple drip strategies side by side. This fund really performed in a way I wasn't expecting. Same starting amount, same assumptions, same timeline. The only thing I changed was how dividends were handled. By the end of this video, you'll see exactly how drip impacts income, share count, and total return, and why blindly reinvesting dividends can backfire. Let's start with the assumptions because that's where most people go wrong. So stay tuned. Welcome back to Simply Money. Today we're looking at CHPY and we're doing our all-in scenario. We're taking one fund where if I put all of my income portfolio into, then we're back testing it to see how it performed with 100% drip, 50% drip, 0 drip, and then what kind of drip would I need? What percentage would I need to maintain my balance if I needed any drip at all? So we're going to be looking at CHPY, and stay tuned to the end because this fund has really performed in a way I was not expecting. Here's the worksheet. For those who are new to the channel, thank you for joining us. What we did here is we have the starting date, the inception date. This is the starting price, and here's the symbol CHPY. Our $525,000 hypothetical portfolio would have bought us 12,605 shares. The reason we do this, not because this is financial advice. This is for informational, educational purposes only. I'm not telling you to buy all of this fund or any fund. In fact, I'm not telling you to buy CHPY at all. I'm just showing you what the backtest data shows for you to take a deeper dive and begin doing your own research. We do this to show, what if I retired and I put all my money in one fund? I think that would be a mistake, but everyone's going to make their own decisions. I would never do that personally. But it is nice seeing how this fund would perform in that scenario. And again, this is short term. In the stock market world, 8, 9, 10 months is a very short time frame. But that's what we have, and that's what we're looking at. As we go down column A, we have the different dates. It's a weekly paying distribution. So each week we have the distribution date here. We have what the share price was on that date. And then we have the dividend or distribution amount and how much it paid. And we'll look at that in the various scenarios. Going down, we can see where we started at 41.65. This is the first surprise because for a high yielding fund like CHPY, it is performing extremely well. See that it climbed up and we had a peak here of about $55. Then it dipped a little bit and it's settled, and then it drove back up into October and then started going down a little bit in November. And it's bouncing around a little bit here of lately in the beginning of December. It has grown its share value in these few months by 33.66%. That's a healthy share appreciation, especially on a high-yielding fund. This is going to be very interesting as we dive into these different scenarios. Over here, we have the distribution amount. You can see here it's down 36 cents at the beginning. And as you go down this, looking at this, you see it's very consistent. There's a few little spikes and dips, but nothing really, really big. Some nice little jumps here and there. It came down a little bit, but again, it's going to fluctuate with the share price, with the volatility of the stock. That's to be expected, but overall, it has averaged a 4.11 cent distribution each and every week, which from its earliest to its latest, now again, there's been some much higher, but it's been in that time frame a 4.38% increase. We can look at that and you can decide, would I want to count that as an increase even though it's gone up and back down? That's based off that average there. Regardless, it's been very consistent overall. When we get into the distribution and how much it pays based on the number of shares we have our full drip scenario here where we take the full drip and we just buy more shares. In this scenario, we are in like an accumulation phase, not only trying to accumulate our value of our portfolio, but also accumulating the number of shares we have. So when we go to turn off the drip, we have many more shares to use that power of the distribution with. Coming down this here, you can see the early payments. Again, this is weekly payments of in the 4,000 range. There's a few spikes here and there. This was a really healthy early on 62-cent distribution. So you had almost an $8,000 payday. You keep scrolling down, but it's been very consistent in the $4,000 or $5,000 range. Now it's kicking up as it continues to grow in the $5,000 and $6,000 range. And now we're looking up in the $6,000 and $7,000 range over the last 2 months. And it has paid out $214,000 because we're taking this distribution based on this share price and we're buying more shares. Over this time frame, we have accumulated 3,965 more shares that you're getting this distribution on than when we began. It's really exponentially growing this distribution in a nice, healthy way. Coming over here to the full value of the drip, if we do a full drip and we just keep accumulating, you can see the share price, the accumulation of shares has caused this portfolio to absolutely explode to $922,000. That's an increase of $400,000 or 75% growth in this short time frame. From April till December, it has grown 75% using drip. That is a great return. You're looking at a high distribution fund that has grown. It has come close to doubling your portfolio in a matter of 8 months. That is incredible. Keep that in mind as we look at this, how this fund has performed. Now we're going to look at the dividend payment of 50% drip. If you take this first payment and you take half of it, the 50%, this is the amount you get here. There's $22.85. This is the amount going down that you are going to drip and buy more shares, and we show that over here in this column. You're getting more shares, but not as fast as with the full drip, obviously, because you're only reinvesting half of the amount, and that half amount becomes lower and lower because you have fewer shares than you do on the full drip. For example, you come down here to the very end, you can see that with the full drip, your distribution was $6,231, where here it's not half, it's $2,727, because you're looking at 16,000 shares compared to only having 14,000 shares. But again, it's paid a nice, steady distribution. 50% of it's being reinvested. The other thing to remember is you are collecting this 50% to live on. While you're reinvesting and building your share count and helping build your portfolio balance, you're also collecting a nice, healthy paycheck week over week over week. And right now it's averaging around $3,000 every single week. That's a $99,000, almost $100,000 distribution that you have received for expenses in this 8-month period. That's averaging over $12,000 a month in income to use, as well as having that $12,000 reinvested to increase your share count by 1,851. Looking at your value, the 50% value, you come down and you see this thing has just grown. Even with the 50% drip, our share value, our portfolio balance has grown to $804,000, a $279,000 increase, a 53% growth rate of your portfolio. And remember, and we'll look at this in a minute, that's in addition to this $99,000 that you have received in income. So your portfolio has ballooned in an amazing way, and you've been receiving $12,000 a month to live on. Not a bad deal. This fund has really performed well. What are your thoughts on CHPY? Do you own CHPY? Have you thought about owning CHPY? Does this impact you at all? Does this make you want to buy CHPY? Looking at it, I love CHPY. I have a position in CHPY for those that didn't know, that don't watch my channel. If you've seen when I do my update of my income portfolio, you can see I have a small position in CHPY, obviously not an all-in amount. I think it's around $22,000 now, somewhere in there. But I am very pleased with CHPY, and I'm going to continue to monitor this and look at buying when it does dip, adding to my position. Now let's go to the zero drip. This is where we're getting the distribution. You're in your phase of needing income and you're using your income. So we're doing zero drip. You get this share amount here when you buy, and you're not adding any shares to it. You're not selling, but you're not adding to it. And this is your distribution each week that you're getting. I want you to watch this. This is a fund where not only are you getting a healthy distribution with no drip, we're going to look at this and see what happens. Again, now you're averaging here $4,000 or $5,000 a week. You come down here to the bottom, it stayed pretty consistent. There's been some spikes. I don't think it's been below $4,000 yet. It has been very healthy. Your average monthly payment has been $23,000. Now, this is if you do zero drip. I'm doing no drip. I'm taking all the distribution and I'm using it, whatever it is, for income, for buying other positions. You've received $23,000 per month, $186,000 in the short time frame, 8 months. And here's the surprising part. This is the part that surprised me more than anything on doing this back test. With the no drip, typically the value of these high yielding ETFs will drop. If they don't drop, they maybe hold steady. But look at this, with taking the full distribution, look at this thing grow. In this small time frame, while you have been taking $186,000 out in distributions, you've increased your portfolio balance by $176,000, a 33% growth. That is incredible. Let's look at this in the full picture. With the full drip, your increase of value has gone up $397,000, a 75% growth rate. If you annualize that, because this has only been 8 months, it would actually be an annualized rate of return of 113%. Crazy amount. That thing has just taken off in this short early stage. I don't believe that's sustainable. I don't think it's going to continue to do that, but that's my opinion. This is a semiconductor fund full of companies that are semiconductor focused, so it's a very high volatility and high growth fund right now. How long it will sustain, if it does sustain, we don't know. Early on, it has been impressive. With the 50% drip, you received your $100,000 here in distributions, and you grew your fund value by $280,000. That brings your total return up to $379,000 or 72.33% return. And if you annualize that, that'd be 108% return. This is, to me, the beautiful part. You take the full distribution, your $186,000, and your $176,000 that you added to your portfolio balance, you have a $363,000 gain for 69.19% total return, or 103% total return annualized. Absolutely incredible here. Typically what we do now is we go over to the adjustable drip, where we can put a particular percentage in and play with that. We're going to go to that in a second, so stay tuned for that. But I want to come down here to these charts because I want you to see a couple things. Now, this is, again, short period with the stock price from inception until now. The blue line is the stock price. The red line is the trend line. What I do, and this is just a very simplified, not rocket science and not a definitive, it's a guide for me. I will look at this trend line, and when the stock price is way above it, I don't want to buy because it's ahead of the trend. But when it dips below that trend line, I look at that as buying opportunity because it's lower than the trend. And as you can see, it usually goes up above it. Then it comes down, goes way above. I wouldn't want to buy here. To see it comes back down, and what's it do after? It goes back up above. So I want to follow the trend line the longer the fund is available and continue to do that. That is something I do to help just guide my buying so it's a little less emotional. If I see it dipping, I don't get crazy and say, oh, okay, it's below the trend line. But historically, in this short period of time, it shows that when it comes below the trend line, it goes back above. So I don't want to buy unless it's below the trend line. That's just a guide. Here we just have the dividend amount. You can see there's a couple spikes here of heavier payments, a few that were a little bit below, but you can see the trend line is slightly up, not anything drastic, but that's nice. We like seeing dividend amounts going up. I also did over here a couple other graphs. We have the dividend amount if we did zero drip. This is how much you're getting paid each week with zero drip. You're just taking the full distribution. Again, you had some really big payments here and here, but overall you can see the trend line is going up and there are some dips, which correlate pretty much with the distribution amount and the stock price amount. Now, what I did here is this is the full drip, the value of your portfolio. This is incredible because what I like seeing is there's only a couple times that it comes down below your trend line, which shows that it's just been a very steady growth on this. Now, there's going to be times, if you hold this for 3, 4, 5 years or longer, you're going to have some times where this blue line goes way down below the trend line. But you'll probably also have some times when it spikes up above it as well, and it should keep a balance. Now, this trend line might flatten a little bit. It might go up more. We don't know. We'll continue to monitor that. I just added those on this particular sheet. If you like this sheet and you want to play around with it, with the adjustable rate that we're going to look at here, you can put in the amount that you want to check out. Maybe it's 30,000, whatever you want to put in there, you can put it in, and you can put your starting date that you want to backtest it to. And then you can also adjust your drip amount. You can place here how much you want to drip. And for a lot of funds, we do that because we want to maintain that balance. We want to make sure that $525,000 balance on this scenario stays as the value of our portfolio. Now, maybe times it drips below, but we're just monitoring that with that amount. With this one, obviously, it grew even with no drip. What you can do with this, and people say, well, what's the purpose of it if you don't need to take a drip? Well, maybe you don't need, what was it, $24,000 a month. Maybe you want to set this to drip where you're only collecting the amount that you need. So let's say your budget is $6,000 a month or $10,000 a month. You can set the drip to where you're getting that. So let's just say $10,000 a month. We can see here that'd be about $2,500 a week. You can see 40% drip would definitely get us there. We're over it on every week. We could go up to 50% to get it a little closer. It looks like it's averaging about that. We'll have to go down the bottom and look. Again, this is a 50-50 drip like we have on the other side, but you could do 40% drip like we started with and say, okay, you're going to get this amount per week. And so you're averaging $14,000 a month. Maybe that's your budget, or that's the amount you want to take out so you can live on some and then reinvest others in other positions. It's really just to give you the option to be able to play around with that. But you can see this is the amount that you're reinvesting. This is the amount that you're collecting. With the reinvested amount, this is the number of shares that you're at because you're buying more shares each week with this distribution. And this is your portfolio balance based on the share price and the number of shares you have. So this is all dynamic and changes. It shows you that you've reinvested almost $79,000, and here you've collected $118,000, which has grown your portfolio by 49% while taking out $14,000 a month. Something to play with. Again, if you like these drip scenarios and you want to play around with this CHPY one, you can go to Buy Me a Coffee in the link below. We have all these available on the shop tab of the Buy Me a Coffee page. Feel free to grab a copy and you'll get your own edible copy there that you can look at and play around with and adjust these different yellow cells to run different scenarios. I want to do one more on this one just for those who are viewing. We're going to do a $50,000 investment, and it adjusted everything. It's basically the percentages will not change. It's the same percentage, but we're just putting it in a dollar amount. Maybe you say, okay, I'm going to take a portion of my portfolio. I'm going to put $50K in this. I need to live off or I want to pull out the distribution, the zero drip. You're looking here at 400 something bucks a week, and you're still growing your portfolio. So at the end of this time, your portfolio is up to about $66,000, and you've taken out about $2,200 a month in this. I mean, that's a great return, a great supplement to your income on something that if you put a portion of your funds in this. Again, do your own research, make your own decisions, know your own risk tolerance, understand the risk. This is investing, and there are risks. This is the CHPY all-in scenario. What are your thoughts? Leave it down below. Thank you for joining me, and we'll see you next time on Simply Money.